In this video, I'll tell you about essential investing strategies that you need to know about, and we're starting right now. Hey guys, Elliot here. So before you start investing in the stock market, you need to have a strategy to follow because investing in random stocks will generally bring you random results. While there are many strategies out there, 4 of them are very well known and they're the ones I will describe for you here. Each of these strategies has its own distinct philosophy and approach, and which one you pick depends on your own financial goals and belief of what will work and make you money in the stock market. And of course, it's perfectly fine to invest using several strategies at a time. So let's get into it, and be sure to stick around as later in the video I will share my opinion on what I think is the best approach and why I happen to think so. The first strategy is called value investing, and while the idea has been around since the beginning of the stock market, it was Warren Buffett who really made this approach famous. The idea behind value investing is fairly easy to follow. You simply research and purchase shares of companies that you believe are solid businesses but are undervalued, or in other words, their share price is unjustifiably low compared to their intrinsic worth. Once purchased, you hold the shares for the long term while they hopefully rise in value, and in the meantime, in many cases, they will pay you dividends while you're holding them. And that's really value investing in a nutshell. Buy solid but temporarily underappreciated companies and hold on to the shares. Now, of course, while it's easy to understand the goal here, the trick is actually picking the right companies. After all, how do you really know they're solid businesses? And how do you know they're undervalued? Well, the first part at least isn't too difficult. If you want to determine the business is on solid footing, you will need to do fundamental analysis on its balance sheets, which by law are freely available in the case of any publicly held company. Value investors look at a number of descriptive measurements such as the company's return on equity, debt to equity ratio, PE ratio, book value, earnings per share, profit margins, expected returns, and many more. They also look at intangible factors such as the competitive advantage the company holds, future demand for its products, and of course the management team. All of this will certainly tell you if the company is profitable and on solid financial footing, but for a value investor, it also has to be priced at a discount. If the market overvalues the business and drives up the share price, it's no longer an attractive purchase. Value investors calculate the intrinsic worth of a company, which is different from its liquidation value and includes the intangibles I just mentioned. They then compare this number to the company's market capitalization to determine if the company is under or overvalued. Now, it's actually very rare that the market would undervalue a company for a long time. Sometimes, however, events conspire to drive down the share price, such as a temporary setback to the business or the industry, and this is when value investors swoop in and purchase at a discount. Value investing is quite doable for the average investor, but how good you get at it depends partially on how much research you're willing to do to find that bargain purchase. If you're curious what Warren Buffett owns, however, you don't have to look too hard, as his holding company Berkshire Hathaway has to declare all holdings. They include Apple, Bank of America, American Express, Chevron, Coca-Cola, Kraft Heinz, and Occidental Petroleum, among others. All solid companies and all purchased when they were briefly undervalued. Okay, let's move on to the next strategy, and that is growth investing. This approach involves buying shares of smaller, newer companies that are poised for explosive growth, hence the name. In a sense, this approach is the direct opposite of value investing. There's no traditional value to be found here because the companies are young and just establishing themselves. However, they may be sitting on emerging technologies and on the cusp of an exciting new market that is just starting to take shape. The hope for every growth investor is that they bet on the right horse. The idea is that these companies will prosper and expand on the back of whatever technology they are developing, and the investor's shares will double, triple, or quadruple in value. These companies almost never pay dividends, so share price appreciation is the only way to make money. The challenge, of course, is to find growth companies that will have a bright future and are not a failed promise or a flash in the pan. Traditionally, these types of companies came from internet, tech, or biotech sectors, but they can also be in other industries such as energy. They were usually disruptors and presented an innovation or a new market trend. Often their technology also had a unique competitive advantage. To identify potential growth stock candidates, it helps to follow market cycles, read industry news, and generally stay on top of trends. Virtually every internet and computer stock you can think of was once a growth investment, and lots of new technologies from blockchain to AI are still in that phase. Once you find a potentially promising growth company, can you analyze its stock? You certainly can, to an extent. Investors look over the company's PE ratio, earnings per share, price to sales ratio, and return on equity. But the truth is that some of these numbers will be off in the traditional sense. For example, the PE ratio, a marker of whether the company is over or undervalued, may be an insane 30 to 40 when S&P 500 companies average around 25. But if this growth continues, then the outsized ratio is mostly ignored when it wouldn't be in a more traditional company. Growth investing is what most novice investors imagine investing to be. You pick a hot stock and watch it go to the moon. Reality, of course, isn't so accommodating, and many have lost a ton of money on this approach. In the end, it's another tool in the investing arsenal that you need to know about, while keeping in mind it's not really a get-rich-quick scheme. Okay, the third strategy we'll take a look at is dividend investing, which is also sometimes referred to as income investing. Now, dividends, if you're not familiar with the term, are nothing more than discretionary payouts of a portion of a company's profits to eligible stockholders. In plain English, it's the company paying you to own a stock, which makes sense as you loan the company money when you bought their shares, so they are paying you interest. In financial language, these dividends are stated as a dollar amount and a percentage. The dollar amount is the annual dividend per share, and the percentage is the yield, which is the percent of the share price that amount represents. So for example, this was the annual dividend yield for Coca-Cola from a few weeks ago. What it's saying is that if you own one share of Coca-Cola, you will receive $1.84 annually, which is 3.16% of the current $58 share price. These payments are distributed on a monthly or quarterly basis, and while this Coca-Cola example wasn't a large dividend payment, the more shares you own, the more you make in profits. If you owned 100 shares, you'd earn $184 annually, and if you collected 1,000 shares, you'd earn $1,844 per year. While still not a fortune, keep in mind that many investors hold tens of thousands of Coca-Cola shares, with Warren Buffett holding about 400 million at the time of this video. If you're wondering how much Coca-Cola pays him in dividends every year, it's 736 million. Dividend investing as a strategy simply means that the investor seeks out and buys dividend-paying stocks, and dividend payments, not stock appreciation, is the focus of their portfolio. Dividend investors do, of course, pay attention to company earnings, expenses, and profits. After all, if the company isn't doing well, dividend cuts are sure to follow. However, in addition to the regular fundamentals, they also look at the dividend payment history and check for how often a company increases its dividend, and of course, if there were any cuts in the past. Typically, it's the stable, larger companies that offer solid and safe dividends in the 2 to 3% range, while slightly riskier companies may pay in the 4 to 6% range. A very low dividend, below 1%, is typically a sign the company is still in the growth phase and reinvests all profits, while an excessively high dividend is typically a warning sign that things aren't going well and the company needs the high dividend to attract investor attention. Okay, let's finish up with the fourth and final investing strategy, index investing. And as I get into it, don't forget to like and subscribe so I can keep bringing you these videos. Index investing is by far the easiest strategy to understand and execute, and it's often the strategy that financial advisors recommend to both novice investors as well as those that don't have the time or interest to pick stocks and prefer an invest and forget approach. Index investing is nothing more than buying shares of a mutual fund or ETF that tracks the stock market index, typically the S&P 500. What that means in plain English is that the index fund buys the same stocks and in the same proportion as contained in the reference index. So as an example, if the fund tracks the S&P 500, it will then purchase a number of shares of all 503 large cap stocks that are in that index in the same proportion or weight. As of this video, Apple, Microsoft, Amazon, Nvidia, and Google comprise the top 5 stocks in S&P 500 by weight, with the top 3 coming in at 7.2%, 6.9%, and 3.5% respectively. And this is exactly how the index fund will have them weighed as well. What you're essentially investing in is the total market. That way your investment will move in lockstep with the S&P 500, which has historically returned an average of 10% on a year-over-year basis. Index funds are a true hands-off investment where you can just purchase new shares on a regular basis and not be concerned with stock selection. You can automate this with dollar cost averaging and a dividend reinvestment plan, which is basically how most 401k accounts work, and really set your investings on autopilot. Another advantage of index funds is the ultra low cost. The reason for that is that you don't need a fund manager to actively pick stocks. A computer essentially does it by just rebalancing the fund in accordance to the minor variations in the underlying index. There are a number of index funds out there, and they all mostly follow the S&P 500, though occasionally may also be the Nasdaq, Dow, Russell 2000, or some other index, including international ones. Okay, so that was a tour of the 4 main investing strategies out there. There are of course others, and there will be a video in the near future on advanced approaches. For now, let's finish up with some recommendations. One thing that has to be said right up front is that there is no one best strategy as far as making the most amount of money investing. If there was, it stands to reason it would be the only strategy, as everyone would gravitate toward it and abandon the rest. Instead, there are best strategies for different types of investors and also depending on what goals they have. So here's the bottom line. I would strongly recommend index investing to anyone just starting out, anyone who doesn't want to be a hands-on investor, or someone like me who believes that a passive investing strategy will bring the best results. I personally have a sizable chunk of my money invested in an index fund and believe that it's the right approach if you're looking for cheap, simple, and reliable. Next, I would recommend value investing to those who are more cautious and conservative and have the time to do extensive research and pick their own stocks. Value investing is also for the long haul, and you will need time, patience, and stock analysis skills to build wealth. As far as growth investing, I would recommend this for anyone who is able to take on much more risk, do proper research, and doesn't mind the wild ride that promising young companies will give your money. And finally, I strongly recommend dividend investing, and this is the second major approach that I follow with my own money. I like how stocks pay me to own them, and I'm not just waiting around in hopes that they will rise in value, but instead collect monthly income. In my case, I specialize in riskier ultra-high dividend investing, where I will focus on stocks that pay out 7 to 12% dividends, but to execute this properly does require a large amount of research, and I will post a few videos in the future on how I do this. Okay, I hope you really enjoyed this tutorial and got a lot out of it. Please do consider subscribing to the channel, and I will see you in the next video.